And on today's show, how various crediting methods work with index annuities. Part 3 of this week's series on index annuities with nationally recognized annuity expert Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmouth. Let's get down to business. Well, welcome to day 3.
Good to be back.
Mike, you've been walking us through the tutorial of the basics. I think we need to lay down a foundation where all advisors can say, hey, I watched this series this week. That was really a good educational piece. For some of our veterans, they'll say that was a great reminder, brought us back into the fold. We want to try to get our common language down so that we're communicating with the consumer in a right way and in a compliance way. Now, when we talk about crediting methods, we get into a potpourri. I mean, there's so much out there on this, I can't tell you. And I would say about a third of everything I read on the net is it cannot be right.
Yeah.
Let's talk about it. We're talking about caps, limitations. We're talking about participating rates, how much I can participate depending upon what the number is. And then this, what I call the magic number, which is the spread. There are 3 different ways. And in the second segment, we're going to talk about, hey, sometimes they combine some of these. So walk me through, let's do caps first.
Okay. Caps, I think, are the simplest to understand, and especially when you talk about the vanguard of the S&P, where everyone can look up into the paper and find out the S&P is at 1,600 and it moved to 1,800. They can hand calculate it out, and if your cap is 4%, then you're going to get up to 4%. It's very simple from that standpoint, but the key advantage of an annual cap is that you start out where that index ended the previous year. So if you have a flat year in your policy, but maybe down 40% like we saw in 2008 and 2009, your return starts down at the bottom. So even though that the index corrected some 40% over that time period and then came up the next year at 20%, that client had a positive return even though that they were still well below that 1,600 starting point. And that's a huge advantage for fixed indexed annuities over anything else that's out in the marketplace.
So caps are the easiest to understand. But then if that's true, and I think it is from a consumer point of view, but sometimes people say, no, I don't want to do the cap, I want to do participation. What's participating rates?
Participation rates are pretty much like what they say. You're going to participate in a certain percentage of your underlying index. So say that it's 40% and the index went up 10% that particular year, then you're going to take a 40% or 4% return on your fixed indexed annuity.
Now, how high have you seen like a cap right now versus a participating rate? What's the highest cap we've seen out in the market?
Oh, in today's marketplace, I think that if you can secure a 4.75 to 5, that's a really high cap in today's interest rate market. And there's some people out there buying business. But again, you have to take a look at the service. Yeah, you have to take a look at the service. You have to take a look at the ratings. You have to take a look at the underlying guarantees.
The renewals.
The renewal rates and everything. You know, are they just buying business and things like that? Participation rates can go all over the place because sometimes they are mixed with annual resets. So true participation rate is probably somewhere in the neighborhood of 35 to 45% right now.
A true rate.
Yeah.
Now, when I'm looking at spreads, which I think is the most difficult to talk to a consumer on, explain the basis of spreads. And I've noticed, at least in my trend, I think that people were pulling away from it a little bit.
Yeah, well, I think that we've seen a reduction just simply because the spreads have gone up. But I will say that part of the growth in the registered rep market, which, by the way, if you take a look at independent broker dealers, their production year over year through May is up over 250% from an industry standpoint.
Wow.
So that speaks to the acceptance in the registered world market, and I think a lot of it has to do with the Barclays Dynamic Index, as well as the opportunity to do a spread. And the fact that spreads have gone up because of lower yields has affected some of those sales. But to answer your question, basically you're going to take a spread at say maybe 3%, just to give a nice round number, is that if your indice goes up anywhere between 0 to 3%, you're not going to have a positive return. You're going to have 0. But anything above that 3%, you're going to get 100% participation in that index above that spread. So if the index returns a 7% for that year, then you have returned a 4% rate of return. The nice thing and what's attractive to clients, especially being in some type of equity-based index over the last 4 or 5 years where we've had great equity returns, is that is an index that allows you unlimited upside potential, because once you suppress that cap, you have nothing else to stop you as long as there's not a participation rate or anything like that on the
So would
indice.
you say the best spreads that are out there do not have any caps, do not have restrictions on their participation
Correct.
rates? So once you're done, you already know, hey, I'm down for 300 basis points. That's what I'm spending.
Yeah.
Everything above the line is mine.
Yeah, and when you compare that versus variable annuities right now, you take a look at M&E charges of 1.25. You take a look at an income rider that's anywhere between 95 to 110 basis points on average, and then you take a look at active sub-account management. And if you want to be aggressive, then you're talking about another 95 basis points to 125. You're pretty much right there at that 3% level anyway of what's going to be taken off your rate of return.
Yeah, except for one small little problem. I got beta galore and no protection.
Exactly.
See, so now that's why I look at the basics on this. Now, when I'm looking at the spreads, the caps, the participation rates, I've noticed, and help me here, I know there's some exceptions to the rule, but usually in the mean average, I'm using a bell curve when I'm talking, I'm looking about, when I get about 10 years, am I missing it? It seems like caps, participation rates, and spreads seem to coalesce, that the returns, no matter what you pretty much did, whether it was annual, point to point, or month to month, using those three, when I get far enough out, they seem to merge. Is that just an illusion on my part?
No, I think that when you take a look at pricing, because caps, monthly sum, spreads, participation rates, they all center around pricing. And that pricing is going to come out to be pretty much similar. I think that the one outlier, though, is the spread with unlimited cap. If you catch a great period of economic growth and high equity exposure in an index, whether it's a volatility managed index or a pure equity index, you have an opportunity to really skew that out of the norms.
We come back from the break. We're going to look more on some of these methods, but more so the combination of these. Now, it's easy. It's hard to just do the one at a time. Now we're going to do a couple at a time. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at down-to-business.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment with Mike McGlothlin. We're talking about crediting methods. Now, we talked about caps, we talked about participation rates, we talked about spreads. We even talked about sometimes that they coalesce at the end of the 10-year, 11-year period. But what happens when we start combining these? It's bad enough that we have to learn these three moving parts, the mechanics, how it operates. Now we're going to add a little bit of combination to it. Have you seen, do they all use different combinations, or is it you seen just two together, or have you ever seen three all together in combination?
I can't remember seeing three together, although I probably exist somewhere out there. I'm not a big fan of using multiple strategies within the same indice. There's multiple levers to pull from an insurance carrier standpoint, and the less levers to pull, the better it is for the client's standpoint. But
is that better for the client's understanding standpoint or their actual return?
both, in my mind. Now, at the end of the day, unless you can tell me exactly what the indice is going to do every day for the next 7 to 10 years, however long you hold that contract, I can't tell you which crediting method's better or whether it would affect it. But I think generally the more limitations, the more averaging, the more caps, then you dilute the rate of return for the client at the end of the day.
Okay, now let's talk about the mechanics of that, because I'm thinking, like, let's say I don't know what the S&P is going to do tomorrow and every day, as you suggested, but I do know what it has done. So if I applied some of the methodology of using two different crediting methods, like let's say caps and participation rates, because that's a popular combo, if I went back and I looked at that and I said, oh, I should have just went caps all the way, or I should have went participation, the combination, as you said, diluted it, because now I have two what I would call confinements or limitations to it. Yeah. And they seem to be working in concert against my total rate of return.
Yeah.
Now, am I imagining that?
Yeah, I mean, a lot of the older contracts we saw maybe a 50% participation rate, but then 6% cap beyond that. We don't see those quite as frequently, but we do see that. Where we see them at play is more in concert with one another. Is you have 25% of your portfolio in an annual cap strategy, maybe another 50% in a participation strategy, and then something else in a monthly sum. Just as long as you can't tell me if the S&P is going to go skyrocket and back down, or if it's going to be a steady climb, and that way it kind of protects you. Again, it's another form of diversification within the fixed indexed annuity.
When you're talking about diversification, that reminds me of something now. Do you see sometimes where a person will pick maybe part of it in his S&P index and maybe take an emerging index, maybe from a third world market, and then have some parked inside the guaranteed fund? Do you see much of that kind of what I would call portfolio diversification within a annuity contract when it's sold?
Yeah, I think there are a couple of things. First of all, we see utilization of the fixed account for CD buyers. When you take a look at CDs at 80 basis points or something like that, and even short-term CDs at close to 24 basis points, I think right now, that for a $100,000 premium, we will stick $50,000 into a one-year fixed account. And so we know that we're going to outpace that CD, and then if we're fortunate enough to get any type of growth, whether it be participation rate or annual reset, we far outpace the CD, but at the same time we've maintained a guaranteed set of growth. So that's where we use the fixed account and time in splitting that money up.
And remember, just a little side note, I know this sounds redundant and so basic, but remember we're talking about tax deferral. So if I'm comparing it to a certificate of deposit, I'm looking again at paying taxes every day on my CD at 24 basis points. By the time I pay taxes, I don't even know why I'm in it. And at the other side, I'm having a deferral. The longer I defer it, then I'm starting to get the power of that kind of leverage against my ordinary income tax bill that my CD's paying every year.
Absolutely, yep.
When I'm talking about combining and using different, I'm using the index, I'm using its side fund guaranteed, I might be mixing and matching. Is that a big call for an advisor? Do they have to kind of know what they're doing if they're going to do that kind of diversification?
Yeah, I think that at the end of the day, and again, what we spoke about in the previous segment, over long periods of time, they all begin to look quite a bit alike. But more importantly, from a sales position, it gives the advisor an opportunity and a reason to go out and contact that advisor or for that client. And when you take a look at fixed index annuities, you're always going to have a positive story. Either the market corrected big time and you preserve that wealth, or the market went up, and if you've placed it in several different indices, it's gone up to some degree. Maybe in an uncapped strategy, you've hit a home run in a portion of the portfolio. So it gives the advisor a reason to go out, and whenever you're out in front of a client, there's an opportunity to make another sale.
I'm looking for a basic strategy. I like diversification. Usually I think of an index annuity as a standalone product to diversify against the rest of my portfolio. But within an indexed, and I'm looking to protect, like you just said, have you seen advisors going this way, just from a trend point of view?
Yeah, from the registered rep market, we've seen incredible growth from that standpoint. We've seen people take gains off the table. We've also seen them take their bond portfolio in a low interest rate, low yield environment to be able to be linked to an equity index and have an opportunity to outpace that. So we've seen a lot of penetration inside of our independent broker dealers.
So there's tactical plays to be had here, and our registered reps actually know this.
Yeah, and that's outside of any type of income riders.
Wow. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site, down2business.ashbrokerage.com. Want to email me? steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.